Good morning, everybody. Welcome to our to Friday and to the Rebel Income live stream. Excited for today's session, and as always, looking forward to being able to talk about what's going on in the market. Hold on just one second here. I apologize for being a few minutes late. Also, didn't have all of my didn't actually put on my microphone. Okay. Again, looking forward to being able to talk about the markets. We have a lot to talk about. One thing that I do want to mention before we do anything else today, last week I made kind of a preliminary announcement about some plans for this live stream. Some of you have responded. You sent me emails and messages to let me know how you felt about changing the schedule of this live stream to go every other week as I was planning. And I really, really appreciate that feedback. That actually means a lot. I've had a week to think about it as a result, and I think that I found a better option. And so I would appreciate those of you that are here, what you think about what I'm about to propose. Put your comment into the chat. I want to try to keep the weekly thing going. To be completely honest, I need more participation than we are getting in this live stream to make that worthwhile. And so the plan is to still keep the same weekly schedule minus next week. Next week is the 4th of July. I'm not going to be doing a live stream on the 4th of July. Sorry. But from July 11th on, I'm going to open up this live stream. Until now, I have only been making the link to this live stream available to members of the ITG group or to paying subscribers. I'm now going to open up this live stream to the general public, so that anybody who wants to participate, anybody who wants to listen, learn about what we're doing with Rebel Income can. And hopefully that's going to help to boost the viewership a little bit, make this still continue to follow the same general method that we do here, talk about the same basic principles related to the Rebel Income system and how that works, but hopefully widen the audience. Let me know what you think about that. Gib, what do you mean by participation? Well, to be completely blunt, besides myself, there's three other people in this live stream right now. And the typical audience in any given week is usually no more than 3 to 4 people besides myself. Now, that doesn't lessen the importance of each of you and how much I value the fact that you're here. And that is why I want to continue to keep this on a weekly basis. I want more viewers, to be completely honest. I need more people attending this live stream, and I need more people participating in it in order to keep it going. Does that make sense? In any event, let me know what you think. Okay, good. Let me know what you think, and if this is something that if you have some other thoughts or some other ideas. Again, I'm open to these because I want to make sure this needs to be what it is. Barry, any ideas to what has happened to all of the others from the previous platform? I think that as an inevitable function of time, a little bit, and to be honest, yeah, some people like Joe and others have run into some personal challenges that have required them to kind of drop off. I think the other part of this is when you do start to when you start to make changes to the platform that you're providing the service on, inevitably some people don't follow, and that's unfortunate. I've worked really, really hard to try to make sure to communicate all of the changes to the entire ITG group, and try to encourage as many people to come over as I can. And you know, obviously those of you that are here, you've done that. And I did get a number of messages from people who aren't on the live stream, but do watch after the fact. And those of you that this applies to, you're just as valuable and just as important to me as those that are here live. That's the other reason that I do feel like it's important to keep this going on a weekly basis. And there's a fair number of those that have been longtime members of the ITG group. They're just not here live, and that's fine. That's great. That's why I make the live stream available after the fact. So I'm trying to find the right balance in order to keep it going and try to continue to give you the same level of attention and service that obviously you deserve. So. Thank you, Gib. Thank you, Barry. I appreciate those questions. Okay. With that said, we are on coming up on the end of June. And so it is Friday. That does mean we do have some positions to look at and evaluate that are expiring today. I also have a couple on deck that we'll be able to review. I expect that we'll have some time, though, to look at some other things. So hopefully you have some other stocks that you'd be interested in looking at. We may even have the time to run through a complete review of some of these stocks on the basis of the Rebel income criteria, and so we can see how that goes. All right, let's go ahead and start here. The first trade that we have to look at is a put sale that I placed, excuse me, about 2 weeks ago on CVS, selling the $64 strike and bringing in a little under 2%. Again, this is for a 2-week time, so this is a nice trade. Let's go ahead and check in and see where that one stands now. And again, from the $64 strike, we've seen obviously a healthy move. This has seen quite a good boost here from this point. Now, the idea of rolling here is something we're going to be exploring. To be honest, you probably could have done that a week ago, and we visited some of those numbers last week as well. So if you are of the preference of trying to manage your trades more actively, then you may have already done this. But the idea here is, of course, when we place a trade on one of these stocks in the Rebel income system, my method is to sell a put option, and then I just kind of wait until after expiration. If I get assigned, I get assigned. That's one of the possible possible results that comes from selling put options. For me, that's one of the reasons I do it, is it allows me to set the price that I'm willing to pay for any given stock. And I look at put selling not only as an income generation tool, but it's also a way for me to buy stocks that I like, to build my portfolio with dividend paying stocks that I think have a lot of upside. And CVS fits that description. Now, with that said, with the stock around 68, the option looks like, unless it collapses, and it would need to really collapse, need to fall all the way down here to $64, which is pretty unlikely in the hours that remain of the market. And we're just getting started, obviously, but still, this is a $4 difference that it would have to cover, and that seems to be pretty unlikely. So for me, this is going to expire worthless, and that's awesome. But let's go ahead and take a look and consider what some of the other possibilities are. All right, need to expand strikes. There we go. So here's the $64 put that I sold, and If any of you, as always, yeah, if any of you have placed the same trade, feel free to share your numbers. And Barry, we'll check. I love the fact that you're sharing NVDL. We'll check in with that here in just a minute. Thank you. Okay. So just for reference here, I sold CVS for $1.20. So $1.20. And looks like, there's pretty big difference between the bid and the ask here. That's a little bit, it's going to be a function of the fact that there's been no trades here, but there's plenty of open interest. So with the bid at 1 cent, that means that you could, if you wanted to try to close this obligation before the market closes, make the capital that you're reserving in this trade, the cash you use to reserve the put, for example. In my case, that would be $6,400. I sold one contract. If I wanted to free that up before the market closed so I could redeploy it, which can be really effective, right? If I wanted to do that, instead of just taking the asking price of 9 cents, I could very likely go somewhere in the middle. Maybe I could put in a buy to close. And again, this isn't a recommendation. This is just an example, but put in a buy to close order for 4 cents. And that would probably be taken. It may not be taken right away. Might have to wait a little bit. So, let the market come to me. But there's enough open interest here that I think that would probably go. That would eliminate the obligation, allow me to redeploy that capital. I could think about whether or not, excuse me, I wanted to roll up and out, go a little bit further out in time. And, here is, remember the stock is picking up some momentum here. It looks like it could even be breaking resistance, possibly, right around 68. Excuse me. Need to take a drink. It could be breaking resistance right here at a little bit below $68. Right now, it looks like it's just, I'm going to call it holding it at that level. But if it continues to break above, that could be a good result. That means that I could sell the 68. Again, not a recommendation, but just an example. Here's a 67 strike for next week. Don't worry about the difference between the bid and ask here. This is just because of the lack of a trade. But at 32, well, that's about not quite 0.5%. And sorry, I'm even on the wrong one. I want to be at 68. Here we go. This is the one I want. Sorry. So you could sell the 73, the $68 strike for 73 cents, get a little over 1% for 6 days. Since this is actually this is a little bit out of the normal because next Friday is July 4th. The market is closed. That means this option expires on Thursday. So you got a little bit less time that you'd have to deal with on it. That means the time decay is going to accelerate that much more quickly. So if the stock continues to push above 68, you'll see this number bleed off that much faster. 0.73 divided by 68, 1.07% for 6 days. Let's just do a simplified annualization of that, times that by 52 weeks. This is why I laugh when people think that put selling is boring. Because if 55% per year is boring, then I don't know what's exciting. All right. So that's CVS. Let's see, Barry, talk about MVDL for just a minute. We've looked at this one in the past weeks because Barry's been following it quite a bit. It says should have stayed in NVDL a little longer. Was in it at around 50, made about 600 on a capital gain. Nice yield on premiums, but now, well. Got a little bit of lift off this week, didn't we? You know, this, just talk about the slope of the trend here. This is already pretty steep slope, but now, zoop. That's a little bit ballistic, isn't it? But still, in the category of should have stayed, coulda, shoulda, woulda. There's always opportunities to say that, right? In the meantime, I really love the numbers you just shared because I think those are really important. You said got in at around $50, so I'm going to call that $50 entry. And we know you made some nice premiums on your covered calls on this, but besides that, there was a $60 capital gain plus covered call premiums. You know, net result there is you did awesome in NVDL, right? And even though maybe you didn't get to participate in this latest this latest acceleration, yeah, there's no reason to feel bad about what you were able to get. And you said, like right now, then just really the temptation here is to try to jump on this bandwagon, right? But in reality, you're looking at a much higher risk now. And momentum people would tell me that I'm up in the night, but you're looking at at an increasing risk of watching this taper back and pull down. That doesn't mean that it's going to correct and reverse the trend, but inevitably, you've got support here at $60. That was the resistance that was broken earlier in the week. So you've got about an $8 difference between where the stock is now and where that support level is. That's where your risk to reward calculation starts to really reverse. In fact, if we want to talk about next resistance here, let's see. You're probably coming up on it. This is at about 71. Ooh, that's an ugly line, sorry. Let's do something a little different, shall we? There we go. Looks like I'm going to put resistance for the stock right around $71. So if you want to talk about risk to reward, again, here's support at 60. So you've got all of this as possible downside. And only about that much upside. So your reward to risk here is really very exaggerated. This is you've got what, maybe $2 of upside to maybe $70.50 roughly. Versus $8 down. Yeah, and you're exactly right. You know, you're not going to go broke taking a profit here and being patient. Doesn't mean NVDL is bad by any stretch. It means right now trying to treat it as a trying to look for a new trade on it is a high risk has a high risk of failure. And so the smart thing is to wait. There's always going to be another opportunity. So I certainly agree with that. And for those of you who may not be familiar with NVDL, this is an ETF that is tied to NVIDIA. So rather than working with NVIDIA at a much higher price, this is a stock that allows you to place a lot of the same kinds of trades, including put sales, covered calls. There are options on this stock, on this ETF, excuse me. So you can trade this just as you would NVIDIA, but at a much lower price and much more manageable price, especially if you have a smaller account. And that's kind of good. Okay. That's NVDL. I appreciate the check-in on that one. Let's go ahead and talk about the next trade that is on deck for expiry today. This is covered call on Barrick Mining, what we've previously called Barrick Gold. And this is a stock that I've held for a little while, being assigned at 2050, and this is a covered call that I sold at exactly the same price. Why do I do that? Well, number one, I've held the position for a little while, and I like the idea of being able to free up the capital that I put into it. I sold 3 contracts here, so that means I own 300 shares. At 2050, that means I'm talking about position of about $7,500 in total. And so if I get called out of this, that gives me an opportunity to increase my cash a little bit so I can keep my powder dry, right? And that I consider that to always be a good thing, even if it means that I'm selling at the same price that I bought the stock at. The income that I've been able to generate through covered calls in this position up to this point, along with dividend distributions, still make the position worthwhile and productive. So let's check in with Barrick Mining. It's been pulling back for the last couple of weeks. It had peaked up here near 22, and it's been falling back, and it's very, very near the price that I was assigned and that I sold my covered call at. So right now, it's kind of 50-50, flip a coin as to whether or not it's going to hold enough momentum to call me out of the position today. I don't know. We will have to see. Could very well drop below 2050 today, and in that case, the option would expire. I would still have those shares. That's okay. This is part of the reason that I keep selling covered calls, as it's just another way to pay myself some extra income, create extra dividends beyond the regular dividend distributions, which are attractive, but only come every quarter. And so covered calls give me an opportunity to accelerate that a little bit more. That's nice. And so we'll see how this one goes. But for now, if it finishes anywhere near its current price above 2050, I will be called out. And that'll be nice. I did bring in about 40 cents per contract on this one, which is nice. That's about the same as the dividend on an annualized basis. And I was able to do that with one covered call. All right. In terms of trades that are coming up in the weeks ahead, don't have anything coming up for next Thursday, but the weeks after that do have a put sell on Skyworks for the 18th, where I sold the 67.50. Now let's just check in with that one. This is doing like CVS right now. Where we're seeing a little bit of a rally higher. Right now it's coming up on 75. Now that's far enough away from the strike price that I sold, 67.50. Doesn't mean that there's anything that's going to happen with my put option. Nobody's going to exercise it when it's that far away from the stock's current price. I'd actually have to drop below this in order for me to worry about being assigned. But what it does open up, even with a couple of weeks still to expiration, is whether or not it might be worth buying back. So here's 67.50. The ask on this is 60 cents. So if I'm not monkeying around at all with trying to maybe take the midpoint between the bid and the ask, which is probably in the neighborhood of, well, let's just put it at 40 cents. Might be a little bit above that, but say 40 cents. Then I would still be able to hang on to 50% of the premium I brought in, remove the obligation 3 weeks in advance. That's after only a little over a week, which is that's not the worst idea. Again, no activity here, but enough open interest that maybe, and here we go, the ask has just dropped from 60 to 40. So you'd be able to get that immediately now. So that would mean hanging on to, if I were to do this, and yes, Joe and Ray and others of our friends are screaming, why aren't you doing this? Here is 75% of the premium could be retained right now if I wanted to buy that back at that current asking price of 40 cents. With that decline, I maybe even be able to massage that a little bit more, maybe 35. 30, maybe not, but maybe. I don't know. There's been no volume, so it'd be hard to say. The question, of course, when you do this, when you roll, is it's not just about whether or not you can retain a portion of those premiums, but another part of the question. Sorry, I thought I saw something out my window. I didn't. Somebody going by. The question here is not only just what you can retain, but also what you're going to do next. And in this case, really the only practical thing to think about and consider doing, considering the momentum of the stock, is since there aren't weekly options to sell on Skyworks here, the only other real practical decision is to decide whether or not you're willing to move up and sell at a higher strike price. Considering the stock's momentum, that's not necessarily a terrible decision. And it is interesting that the 72.50 has a $1.05 offer there. That's $2.20 on the ask, $1 and $1.85. So it's narrowed a little bit. Here's the range for the day, 112 and 115. So again, not a recommendation to buy or sell, but 72.50. If you bought back the 67.50 and were willing to roll up to 72.50, I would probably put in a sell to open here. I would probably put it at 120. Just to see if I got it. And wait for the market to come to me. Yeah, Gib, good pickup. Earnings on the 29th. That's right here. Around Wednesday the 30th. I'm going to go with the 29th. I'm going to go with you there. That does mean you need to consider that. And this, fortunately, this would expire before that. So you wouldn't have to worry about holding a position, with a cover call, or possibly, this is one of the things you have to consider, even with put sales, certainly, is if the trade is crossing an earnings calendar. I try to avoid those setups, not because they're bad or because I'm afraid of them, just because they create uncertainty that can complicate the trades a little bit for a lot of people that are following the Rebel income system. But sometimes there have been cases where I've placed these trades. If I feel like the fundamentals are strong enough, the opportunity is strong enough, there have been cases where I've done it. But it does create the potential for increased volatility around the earnings date, and that can make things a little bit, that can make the ride a little bit hairier. Gotcha, Gib. All right. The only other trade on deck was this week's put sale, which was on Campbell Soup, selling the $31 strike, and brought in about 65 cents on this. I went out a little bit further in time on this one than the trading alert I had published said. I was planning, the trading alert I published had a 9-day trade. I went out 16. I went for a little bit more premium on this, and so I went out an extra week. So I'm at 31, and there's still an open question here. When I sold that option, this is where I thought support was going to be. So about 31.50. I thought I was going in a little bit below that support level. Well, now it looks like we're trying to define support around 31. So who knows? right now, the only thing that you can really reasonably say is that the downward trend is down, is continuing. Downward trend is down. That's a Captain Obvious statement. Sorry. The downward trend is extending itself. Does that mean that this is a trade of catching a falling knife? I don't think so, because to me, the falling knife question begs fundamental strength. And that doesn't mean that when I sell these put options, I do it with the understanding I'm selling stocks that are in downward trends. Sometimes they are in the midst of consolidation periods, and that's what I thought might be developing in this case. But in any case, they're still in downward trends, and that means that those downward trends can reassert themselves at any given point, even on fundamentally strong stocks. That's why I care about fundamental analysis. That's why I care about where I think the value is. And why, to me, the question is whether or not the strike price that I'm selling provides me a potentially good purchase price for the stock relative to where I think the long-term upside is. Eventually, at some point, Campbell's is going to reverse. I'm not saying when. I'm not going to try to predict when that is. But the longer this downward trend extends itself, and it's now going on a full year, right? We started all the way up here at around 52. And now we're down here around 31. That downward trend is going to stop at some point. The market is going to start to recognize the strength in not only Campbell Soup, but in food products in general. The entire industry is being sold off right now, as the market and investors are tending to take a more of a risk-on approach. They're kind of embracing stocks with higher growth profiles, NVIDIA, and some of the others along those lines. So these are stocks that tend to get dismissed under those conditions. That's where the opportunity lies for me. But it does mean I have to be willing to accept that I might be assigned, and it might mean having to be a little bit patient while I wait for the market to recognize that strength again. Barry went out to next week, so you've got 7 days less time and brought in almost as much as I did. So thank you for sharing that, Barry. I appreciate it. Barry gets the tick mark because you're accelerating the compounding effect on the trade. That's nice. Let's show the difference, because I think this is material. When I sold my put option, I brought in 65 cents for 2 weeks of time, 16 days. So let's take 365 and we're going to divide that by 16. Means I can place up to 22 trades. I'm not going to round up and call this 23. And Gib, I'll answer your question here in just a minute. So this is 22 trades. I was able to bring in 2.1% times 22. So about 46% on an annualized basis, if you can repeat the same result every 2 weeks. This is an idealized result, simplified, but still possible. By comparison, I'm going to make a couple of assumptions, Barry, in your case. Maybe more likely to get it assigned without the extra time to correct. Maybe less likely. again, and even if you are assigned, that does offer the potential for to be able to turn around and place a covered call more quickly than I would, right? In any event, $31 strike, 57 cents. So 1.83%, but this is 9 days instead of 16. So that's possibly up to 40 trades. So 40 times 1.83%. So my result, nice, 46% on an annualized basis. This is the advantage of selling less, of both of selling less time and being able to increase your trading frequency. This is why so many people that are part of the Rebel Income community prefer to take a more active management approach. They're trying to increase their trading frequency, which is very reasonable. By doing that, you're setting up the opportunity to compound your returns by that much more. So, okay. Gib, I know we don't talk about it, but what about vertical call spreads? Just follow the same Rebel Income rules and key points. So, with a vertical call spread, what you're talking about, instead of buying the stock, right? You're talking about buying a call option at with a strike price, maybe at or possibly even a little bit in the money, maybe at the money, possibly in the money, but pretty close to where the strike price, the stock's current price is. Then you sell a covered call with a shorter time period. The call you buy should have a little bit longer time period. Some people may set this up literally with the same expirations, and that's fine too. In any event, you're going to buy that and then sell a call at a higher strike price. Now, you're going to still be looking at a net debit on that trade. And the maximum possible gain is going to be the difference between the strike prices that you use between the two options. You can do those. I prefer to buy more time in those cases if I'm going to place that trade. So I might buy 3 months of time so that I can sell 1 month of time. The advantage that gives is that you still have essentially the same setup as a covered call. The trade technically by your broker's requirements would be considered a margin trade. So you have to be approved for naked call selling, because that the call that you sell is not going to be considered covered in any way. In reality, the long call with the longer expiration in this case provides the same function that owning the stock outright would do. Because if you get called out of the option that you have sold, your broker is going to exercise the call option that you own, buy the stock at that price, and then clear the position for you. So in literal terms, the execution is very, very similar to a covered call, just requires a couple of other steps on your broker side. But again, it does require a higher level of permissions. So if you're not approved for selling naked calls, and don't get stressed about me using that term, because in literal terms, with the vertical call spread we're talking about, it's really not naked. It is covered. It's just the way that the broker is interpreting it. So it's not terrible. I've done them in the past. They tend to be not as productive as I want them to be honest. A lot of times it's more like it works out a little bit more. I don't know. You don't. The other part of it is that if there's any dividend distributions during that period, you're not going to get them. The only way you get the dividend distributions is to own the stock. So for my money, if I'm going to be looking for an opportunity to sell the call, I might as well just own the stock. That's one of the reasons that I publish a covered call trade as a put sale when I publish my trading alerts, because sometimes the put options aren't as attractive. And in those cases, sometimes covered calls look a lot better. And if it's still a company I like, that can still be really productive and really useful. So I'll be honest, rather than the vertical call spreads, my preference is just going to be to buy the stock and then sell the call. Gib, yes, you're literally speaking. He's absolutely correct. He's saying, I'm just selling a call at X, right? So let's just say 50 for the sake of argument, right? Well, yeah, the call you may be selling is at 50. Let's say that you're buying a longer term call down here. Let's call it 45. So your risk is the $5 difference minus whatever you're bringing in premium. And if you are using the same expiration date, that's fine. When I have placed those, I've tended to come out with the negative result more often than not. Net negative. So I don't like the probabilities on those as much. But that's just me. Oh, interesting. Gib, you would invert the story. You would sell a 50 and buy a 55. Think about that though. If you get called out, if the stock continues to rally, you're selling. The possible price you may be forced to sell is at 50, whereas you're going to buy at 55. You're putting a cap on your risk, yes, but to me, you're just increasing the probability of having that net negative result, especially if the stock is in an upward trend. I think you'll find that the probabilities of success with those are not as high as you think. That's just my experience. And for me, this is all about probabilities, right? This isn't about trying to think about, how much capital I have to work with, and how I can try to do this easier with less money. This is about what is the probability of success. And for me, the better probability, if I'm not going to sell a put option, is a covered call. Buy the stock outright. If you're thinking about doing a vertical call spread, you might as well just buy the stock, sell the call. The only way that the trade that you're talking about really works and would be productive is if the stock is in a downward trend. And I will personally, again, I'm down or flat, maybe. I don't like those trades. Sorry. Go ahead and try them if you like. I think that you're going to, downward trends tend to not last as long as upward trends. And yes, they can extend. We saw with CPB, right? It's already been a year. It could extend even further. But the stabilization points, rally points for for new upward trends out of downward trends. Upward reversals tend to happen a little bit more quickly in most cases. Unless a stock just encounters some kind of news or event that just causes it to fall off a cliff. COVID happens or something like that. Then you get massive downside on those. But when you talk about probabilities of success, again, this is what I'm coming back to when all is said and done. Even if you're talking about selling vertical call spreads into a downward trend, you're going to find that the probabilities are not the same. Okay, but I appreciate the question. And thank you for clarifying your intent as I was trying to answer it. So, and by the way, the comment here says I'm having a hard time finding stocks that meet the put side rules. Don't take that as a bad thing. Being more selective is a good thing in the long run. And sometimes, if it is harder to find the kind of trade that you want, a lot of times that's the market telling you something. It's not telling you to go and reverse your method, go and try a different trade. A lot of times it's telling you, be more patient, be more selective. I've written about this in the past, but I'm going to throw this out again. It's a phrase that my mother used to use on me all the time when I would get an allowance or make a little bit of money. She'd tell me, don't let your money burn a hole in your pocket. Same thing happens in trading. We get really antsy, kind of nervous if we're not placing a trade. Our money's not working for us. That's not true. If you're being more selective and maybe trading a little less frequently, that's not a bad thing, because it also means that you're exposing yourself to less risk. You're being a little bit more cautious. Sometimes you have to be willing to listen to the signals that the market is giving and just accept that that's the way it is. You're not comparing yourself to anybody except yourself. I'm not trying to beat the market. I'm not trying to beat Barry or Gibb or anybody else. I hope you're not trying to beat me. I hope you're just trying to place functional trades for yourself. And then the result is the result. And whatever that is, that's good enough. If you feel like market volatility is increasing or risk is increasing, maybe passing on a trade for a week or so is not a bad thing. I reserve the right to pause these trades at any given point on that basis. I'll just say it's not a good week to place a trade. Come back next time. So yeah, if you're having a harder time finding a trade, doesn't mean you're not going to be productive. It just means maybe you need to be willing to be a little bit more patient. Anyway, I hope that helps. I really appreciate everybody's participation and your comments. As always, this is something that makes this session really, really useful. And as always, this live stream keeps me engaged. I really enjoy it. That's the other reason I really wanted to try to do what I could to make sure that we can keep this going every week. So again, if you have comments, feedback, thoughts, suggestions for some things that we can do with this as well, I'm putting in my my email address in the chat area right now, rebelincomesystem@gmail.com. You can also reach out to me on Discord or send me a message on Substack. Either way, whatever platform you're on. In the meantime, again, we will not have a live stream on the 4th. That's next week, next Friday. But I will see you again on the 11th. So enjoy a couple of weeks. I hope you have some fun with your families, with the people that you love. Stay safe, and we will talk again next time. Thanks, everybody.